Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, definitely hit like, hit subscribe, and that way you can see future videos as well. So today we're going to talk about Mohnish Pabrai. So he released a letter to shareholders earlier this year, which had some phenomenal points around why he holds the investments that he does. Not necessarily going into specifics on different companies or anything like that, but certainly specifics around the mindset that he has going into those investments and the reason he buys them in the first place and holds them for a long period of time. So if you don't know who Mohnish Pabrai is, he's one of the greatest value investors on the planet, in my mind especially. So I'll put a picture of him up here. When he first started investing in the late 90s, he was doing right around 70% per year returns, 70%.
All that, but I took the 1 million and I started spending 10-15 hours a week making investments, right? Now, from 94 to 99, or almost till 2000, first 5 years, I did 70% a year, way above 24%. 1 million became 10 million in about 5 years.
Which is ridiculous. He certainly hasn't maintained that higher rate of return over a long period of time, but he still was doing just south of 30% a year for a long period of time. And even after a big drop through the financial crisis in 2008, he's still averaging north of 15% a year based on the last data that we had. So he's actually had a couple of rough sort of last quarters, especially when you compare it against the market that's just been screaming along this last 6 months or so. So it's really interesting to get his perspective on the investments that he does currently hold, why he holds them, and some of the things that he's looking to do in the future. Some of the things that he's looking to not do are what will probably really jump out at you. So I'm going to read through this letter. It's relatively short, so that shouldn't take me too long, and then we'll dive into some of the points. I've just also got Mohnish's books here, so I've read the Dhandho Investor, phenomenal read. There should be a link in the description to this if you are interested. Really good read. I'm actually also reading another book that was recommended by Mohnish, so this is right around 2,000 years old. Some of the lessons and things that have come out of this book. This is The Art of Living by Epictetus, and I even stopped on page 72 last night. So if you know anything about Mohnish Pabrai and the rule of 72, I think my first ever YouTube video was on the rule of 72. Thought it was fitting to stop on page 72 last night on a book recommended by Mohnish. So let's dive into this letter. Disclaimer, I am a big Mohnish fanboy, so don't blame me if I agree with pretty much everything he says, but I thought there's some really cool perspectives on here that the everyday investor can take into their investing sort of practices as well. So let's get into it. Alright, so here we go, the letter from Mohnish Pabrai, his Q1 investor letter to shareholders. This is dated April 25th, 2019, so there have been actually a couple of changes to some of the things Mohnish says, particularly around one point around changes to the portfolio, but I'll get to that in a sec. So, here we go. It's not worth reading too much into the results of a single quarter. When markets are up double digits in a single quarter, we are unlikely to keep up. 3 of our larger positions, Fiat Chrysler, Micron Technology, and Rain Industries, are facing temporary headwinds in their businesses during the first half of 2019. All 3 management teams expect these headwinds to dissipate in the second half of 2019 and beyond. Our investments in these businesses have very little to do with their short-term results. What I care about is the underlying intrinsic value of these businesses in a few years. While there are no guarantees in investing, we are likely to do very well with these and other holdings. The 3 funds own fractions of a set of wonderful businesses run by exceptional leaders. In the last few years, we've added some remarkable assets to the portfolio at significant discounts to underlying intrinsic value. My biggest challenge is to avoid doing anything to this terrific portfolio for several years. If I can just sit on my ass and do nothing for a few years, I think we'll be very well off. As Harina will attest, who I believe is Mohnish's wife, I'm pretty good at doing nothing, so that's the plan. Unless spectacular opportunities show up, there will be a few tweaks around the edges, but not much beyond that. So I'll just jump in here. So there has been one tweak around the edges, I suppose. So Mohnish has actually bought into a new company, so one of these spectacular opportunities did show up. This isn't a stock recommendation from me or anything, but he did invest in a company called GraphTech International, which in short, produces graphite electrodes used for electronic arc furnace or electric arc furnace steel production. So if that happens to be in your circle of competence, that might be something worth looking into. But GraphTech International has been added to the portfolio since this letter came out. So there'll be a few tweaks around the edges, but not much beyond that. I would not be surprised if some of our bets flatline or even go south. A high error rate is par for the course in equity investing. Even with a few mistakes that will be sure to reveal themselves in the next few years, the results should be very acceptable. There is no other set of stocks that I would rather have the Pabrai family assets invested into. There you go. So very cool letter from Mohnish. Short and sweet. He's a phenomenal writer. I think he gets some very powerful messages across very quickly, but I really want to dive into some specifics on a couple of the points that he brings up here, and hopefully you can apply that to your investing sort of strategy as well. So the very first sentence that Mohnish has in this letter has massive implications for individual investors, and it's actually a huge advantage that individual investors have over several professional investors. And Mohnish says it's not worth reading too much into the results of a single quarter. So let's get into that. So if you don't know, the predominant way of measuring performance for most professional investment managers, so your mutual funds and that sort of thing, essentially they're judged on a quarter by quarter basis. So that does some very funny things to stock prices oftentimes in the short term. So me and you are not, unless you happen to be a mutual fund manager watching my channel, which I doubt, me and you are not judged on a quarterly basis. If we underperform the market or overperform the market for a certain quarter, we're not going to be fired from our job, and we're not going to be promoted to, managing more money or anything like that. So we don't really care about individual single quarter results. We care about what the portfolio is doing in 10, 20, 30, 40 years time, depending on your investment time frame. And like I say, that does some funny things to stock prices. So Mohnish is one of those people that has his own fund. He's an independent sort of manager. He doesn't report to a larger mutual fund or anything like that. He simply reports to investors. So that means that he doesn't have to focus on individual quarter results. And what that allows him to do is hold on to stocks that are getting beaten up if he believes that they are still at a big discount to intrinsic value. And that is really, really different from the way that mutual fund managers are able to manage their investments. So if they have a stock that is plummeting and all the other mutual fund managers are getting out and forcing that price down and down and down and down, he doesn't want to be the last one standing there still holding on to that stock. He's going to get hammered in that individual quarter, and the goal of that mutual fund manager is basically to hold on to assets under management and hold on to his job. And the way that is done is not necessarily by thrashing the market over the long term. It is done by avoiding big losses and surprises to investors and pension fund managers and that sort of thing in the short term. They don't want to see a 10% drop in their portfolio in one quarter or anything like that. So they tend to get out of these stocks. They're very focused on individual quarter performance. So they almost become like momentum investors, trying to catch trends, short-term trends, things like that, rather than looking at underlying business performance and the intrinsic value of a business like Mohnish does, and like me and you should be doing as well. So that is a very powerful first sentence, even from Mohnish there. So some other things. Some of our larger holdings, Fiat Chrysler, Micron Technologies, Rain Industries, are facing temporary headwinds in their businesses during the first half of 2019. So this is a pretty interesting one. So one of the things that I've heard Mohnish talk about a lot in lectures that he's done and things that he posts on his YouTube channel, which you should certainly check out if you haven't seen it before, is that fundamental business change does not happen in a quarter. Fundamental business change takes years and years to occur very often. So he really doesn't get caught up in short-term issues. So if you're invested in a business that has a lot of exposure to China or to the trade tariffs coming in at the moment, you're going to be facing a lot of headwinds in those businesses, and chances are the stock price is probably down on that business at the moment. So that means a couple of things. So first you have to make a judgment on, is this tariff situation or is the China stuff or whatever it is just mutual fund managers getting out and being scared, like I spoke about in the previous point? Or is this a long-term fundamental change to the business? So for example, Facebook, they don't have exposure to China or steel tariffs or anything like that, but they were facing short-term, or still even are facing some short-term headwinds in their business. They've got security concerns. Mark Zuckerberg had to get up and speak in front of Congress around the Cambridge Analytica scandal and that sort of thing. But when you look at the underlying data, people aren't leaving the Facebook platform. Revenue continues to grow, earnings continue to grow, all these sorts of things. They're spending a lot of money on security. They're investing back into the business in the short term, so there'll be some little bit of short-term pain, maybe some slower growth in terms of profitability than first expected, but over the long term that should benefit the Facebook business a lot. So that's the type of thing that you should be focusing on in the businesses you own. Are they going to perform very well over the long term? If we fast forward 5 or 10 years from now, are they going to produce great results? Not necessarily are they going to have a rough quarter, are they going to have to up spending or going to be slightly down on revenue in the next quarter. So focus on the long term with your businesses. That's how you do very, very well in the long term with investing, as simple as it sounds. So that's the next one. So the other thing Mohnish mentioned is, and I've just skipped over this, but the markets are up double digits in a single quarter and we're unlikely to keep up. So this is an interesting one. So this is also something that I noticed Warren Buffett spoke about in his early sort of Buffett partnership. So if you don't know, before Warren Buffett was managing Berkshire Hathaway and was a very major shareholder in Berkshire Hathaway, he was managing money for friends and family and some of the Ben Graham partnership investors after Ben Graham retired in the Buffett partnership, which was actually a group of multiple sort of different investment funds that Buffett had. And he spoke about this too. So you can actually go back and track down some of those Buffett partnership letters, very similar to kind of like the Berkshire Hathaway shareholder letters are now, in that he writes it in layman's terms, very easy to understand kind of language, and he talks to you like a regular person and all that stuff. But he was doing this before the Berkshire Hathaway, sort of takeover, I suppose. So this was in the time where he was doing, 30% a year on average through those partnership years. And even then, when he was doing 30% a year, he was also struggling to keep up in raging bull markets. And there's a couple of reasons for this. So I think in bull markets, you tend to get the growth stocks and the high flyers, excelling, and the non-profitable companies, the Ubers, the Beyond Meats of the world and that sort of thing really skyrocket and pushing the market higher and higher. And the other thing I think you get is you have these big mammoth companies that make up huge percentage of these market cap sort of weighted indexes. So what I mean by that is, I think Apple represents 3 or 4 or 5% of the S&P 500 because they're such a huge company within the S&P 500. So when you have, Apple and Amazon and these huge companies start to really take off, and they're companies that a lot of value investors don't necessarily own, even though Berkshire owns both of those in that example, probably not a great example. But when these big companies do take off, you'll see the market, if you're looking at, say, the S&P 500, really take off. Although in reality, it might just be a couple of businesses or a handful of businesses really powering along, and the cheaper, undervalued type stuff is still lagging behind the market generally. So that's an interesting point, something that you'll see with a lot of value investors, especially ones that are managing smaller amounts of money and don't necessarily have to invest in those, huge Goliath companies. They're focused a little bit more on smaller market cap businesses because that's where they often find the biggest discounts to intrinsic value. So the next point I want to dive into is something that I think a lot of people really don't focus on when they are investing in the market. So I see, I've actually joined, I joined a value investing, just a little side rant here. I joined a value investing Facebook page on Facebook, obviously, the other day, and I actually joined a dividend investing one and all these, a couple different sort of investment Facebook pages. And some of the posts I saw on there were blew my mind. Some of the questions that were being asked, and this isn't shooting down any of the people that are in that value group or in that dividend investing group or anything like that. But I saw a lot of people in there asking questions like, I'm up 10% on this position, should I sell it? Or I'm up 20% on this position, should I sell it? Or I'm down 10% on this position, should I sell it? Couple of things on that. So first thing, if you're taking your advice off Facebook, what are you doing? Second thing with that is I think people really forget about the underlying goal. So perhaps they are just speculating on price, and that really is what it is. They are looking to, rotate in and out of a handful of businesses for small profits, which I think is risky and has a lot of frictional costs over the long term. So a lot of commission costs, a lot of capital gains taxes if you're exposed to that, a lot of costs that really add up and retract from your compounding effect over the long term. So you may be able to do 8 or 10% a year with that strategy possibly, but if you're paying 2 or 3 or 4% in all these commissions and all these taxes and things from rotating in and out of the stock so regularly, then you're now only doing 3, 4, 5, 6% a year, something like that. So your actual rate of return over the long term is much lower when you take that strategy. But I think people are not focusing on this point, which is something that Mohnish is laser focused on, and that is buying businesses for less than they're worth, buying businesses for less than their intrinsic value. So Mohnish words it like this: in the last few years, we've added some remarkable assets to the portfolio at significant discounts to intrinsic value. And earlier on, actually, he says, investments in these businesses have very little to do with their short-term results. What I care about is underlying intrinsic value of these businesses in a few years' time. So a couple of things. So first off, he's buying assets for below intrinsic value. That does a couple of things. So that is buying $1 for 50 cents. That's the simplest way to word what Mohnish is saying here. He's looking at what's a business fundamentally worth based on the cash flows of that business and the expected performance in the future of that business. Okay, it's worth $1. I'm buying it for 50 cents or 40 cents or 60 cents, somewhere in that ballpark. Buying it for a big discount. And that does a couple of things. So if you buy something for 50% off, it is unlikely that it's going to go down significantly, at least over the long term. It's not going to go to 25 cents on the dollar unless we get into a Great Depression situation or something like that. So that's the first thing. The second thing is it creates this big margin of safety. So you avoid a lot of that downside potentially. But you also create a lot more upside. So for every 5 or 10% cheaper that you can buy that stock relative to intrinsic value, the more upside you create. So if you buy something for half of what it's worth, then if it goes back to intrinsic value, you get a double. You make 100% return. If you buy something for 25 cents on the dollar and it goes back to intrinsic value, you get a 4x. You get a huge return there. So it has this weird effect, which the wider financial community will tell you is impossible, which is it reduces risk and it increases your rate of return. And usually combining those two things isn't something that people fundamentally think you can do. They think if you want a high return, you have to have high risk. If you want low risk, then you have to settle for a low return. And that is something that Mohnish has proven is wrong over the long term. He's excelled, phenomenally over the long term. Just like Buffett, just like Munger, just like, Joel Greenblatt, all these, famous value investors who've done exceptionally well by implementing this kind of strategy, buying things for less than intrinsic value and not necessarily focusing on quarter to quarter business performance. They want to look at, what's the business worth in 5 or 10 or 20 years time relative to what it's worth today. If it's worth, $10 a share today and I think it's fundamentally going to be worth 30 in the future, I don't particularly care if it goes to 12 or 15 or 20. I'm probably not going to sell it. I'm not interested in these 10 or 20% gains. I'm also not particularly scared about 10 or 20 or 30% drops because I can buy more if I'm confident it's going to be worth 30 in the future. And all you're doing is creating a bigger margin of safety and focusing on that, long term. It's going to be worth this. So, eventually these prices will revert back to intrinsic value and I can really benefit from that. So the next thing here, my biggest challenge is to avoid doing anything to this terrific portfolio for several years. If I sit on my ass and do nothing for a few years, I think we'll be very well off. So this is something that you hear all the time from the great investors. You hear it from Munger a lot. Charlie Munger actually talks about this a huge amount, that if you can identify great businesses and you can sit on your ass and do nothing, that is the greatest strategy on the planet. But it's also one of the toughest, especially if you manage money professionally. If you manage money as a private person, you have a day job and all that sort of thing, it's pretty easy to just buy and hold, leave that money invested in wherever you choose to put it and kind of forget about it for a few years. Maybe that's not easy for you. I find that relatively simple, stress-free to do. So that's the first thing. But when you're managing money professionally, Buffett calls it something called the institutional imperative. So that is, if you're getting paid to manage money professionally, and you think the best thing to do is just sit on your butt and not do much, that's hard to do. If you're in an office 8 or 9 or 10 hours a day or whatever it is, and all you have to do is study businesses, maybe do some general reading and not actually do anything, it's a really tough thing. So what you often see with mutual fund managers is you see huge portfolio turnover. So portfolio turnover is, if you look at all of the assets owned by a mutual fund at a particular point in time, then maybe looking either a quarter later or a year later, you'll get this portfolio turnover data, which basically means how much of the assets that they owned at the start of that period were sold and replaced with another asset by the end of that period. And you often see really high portfolio turnover in mutual funds. If you look at Buffett, you'll see basically no portfolio turnover. If you look at Pabrai, you'll see next to no portfolio turnover as well. These guys are just identifying great businesses, realizing that really high return opportunities that are low risk don't come along that often. So when they do find them, they're getting in heavily and they're just holding them for a long period of time. So I thought that was very cool. And the final thing I want to talk about is this pretty interesting sentence at the end. So one of the things that I find with management leaders in general, so although Pabrai is not managing a public company or anything like that, this is rare to see with public company managers, other than basically Warren Buffett is the only guy I've really seen talk about this, and that he's basically saying he's perfectly open to failing and he will probably make some big mistakes. So I would not be surprised if some of our bets flatline or even go south. A high error rate is par for the course in equity investing. So Mohnish has this lecture on YouTube called, I think it's called something along the lines of the 10 Commandments of Value Investing, or the 10 Commandments for Investing, or something like that. And one of the things that he talks about is you will be wrong at least a third of the time, and you have to basically accept that. So one of the things that is great with this type of strategy when you are wrong on a regular basis is, first off, you bought with a margin of safety. So your downside, if you've done that part correctly, is limited. If you're buying something for less than what it's worth, even if you're way off on your valuation, you're using a factor of a 50% discount. So hopefully you're not, a 50% out on your valuation. And if you're not, you're probably going to be okay. You may get out of the business at a slight loss if you think your evaluation was definitely wrong, and that evaluation isn't something you should be reassessing the week after you buy it, but maybe a year or two later, if what you thought was going to happen with that business just didn't rear its head, didn't happen. You should hopefully be able to get out of that business without losing any money if you've done your initial purchase price sort of job well. So that's the first thing, and that's the beautiful thing about a value investing type strategy, is you can buy things for this margin of safety price and really limit your downside. And the second thing is, you only need a handful of businesses to perform very well over the long term to get great results. So the best example with Mohnish is, he's got Fiat Chrysler. He still owns Fiat Chrysler. That's been about an 8-bagger for him. So it's done about it's about as 8 times as valuable as when he first bought it, if you include the Ferrari spin-off. So Fiat Chrysler used to own Ferrari as well, and they IPO'd that business off into a separate stock. So, Chrysler shareholders got given stock in Ferrari as well, but that's neither here nor there. Basically, Mohnish got an 8-bagger on that investment. So if you have an 8-bagger and you have a few of those over your investment lifetime, and you have, a couple of things that you maybe lose 20% on, the 20% losses don't mean much. If you're relatively concentrated, you get really phenomenal returns from a handful of businesses, and you mix that in with a couple of mistakes. Like Mohnish said, the result should be perfectly adequate, and he's very comfortable having the Pabrai family assets invested in those businesses. So that's Mohnish's letter. I'm a big fan, as you can probably tell, of his investing strategy and all of the content that he puts out and the foundational work that he actually does as well. He does a lot of charity work. So Mohnish is an awesome investor to follow. He's definitely on my list of 13 Fs to follow to get business ideas to investigate and that sort of thing. So hope you enjoyed the video. Hope you got something good out of it. If you did, hit like, hit subscribe. That does really help the channel out and help sort of grow the channel and all those kinds of things. So I would very much appreciate that. You can watch other videos over there, and you can subscribe to the channel if you haven't already over there. So have a great day. Cheers.